Hello everyone, welcome back. This is part 2 of our lecture for this week on the state of the global economy and theorizing the world economy. This is part 2 of our third installment. So this is a follow-on to the lecture we were just having, where we talked at some length about things like the emergence of neoliberalism, about some of the values associated with the way government was carried out according to a neoliberal agenda in the build-up to the financial crisis that developed in America in 2008. And of course we talked about how much of that financial crisis was grounded in an agenda of deregulation, which started in the 1970s really, with the Nixon decision to come off the gold standard, but developed again and again and again through the Reagan years, and then reached a crescendo with Clinton, who decided to repeal the Glass-Steagall Act, or at least get Congress to do that. And Congress, in an alliance between Democrats and Republicans, agreed that that legislation should be introduced. Now today, for part 2 of this lecture, we're going to just talk a little bit about some of the relationship between neoliberalism and financial crises elsewhere in the world. So we have some things to talk about here. I'm not sure how many of you will be familiar with the idea of the 1997 Asian financial crisis, but it was a bad crisis that happened pretty much out of the blue, really. People hadn't really seen it coming. Some people said they predicted it, but it's not clear even that they knew exactly what was coming or how bad it would be. But pretty much the entire world economy was invested into Southeast Asia at the time. You can see here in the map the countries that were involved in the financial crisis. There was a lot of cash flowing into the region from around the world, investment cash, some of it in the form of what we call foreign direct investment, which means that it was being put into building factories and things like that. But other monies were going into the area that were not FDI. They were more investment capital or speculative capital. So that's something to think about. So what is the Asian financial crisis then? It is a crisis that affected the ASEAN countries, Indonesia, Malaysia, Thailand, and Singapore. They had been doing really, really well in the preceding 30 years. They were known as the Asian Tigers. And that was not exactly an unfair term either, because if you think about it, those countries had really transformed their economic situation dramatically over the 30 years. They had gone from being pretty much third world backwards economies to being very, very developed with industrial sectors that were putting a lot of people to work, changing the nature of their society. So there's a lot to sort of be proud of really for them during that time, especially their emergence from World War II through these 30 years. So it wasn't for nothing they were called the Asian Tigers. There's some facts here from The Economist magazine. Malaysia, Indonesia, and Thailand average income more than quadrupled between 1965 and 1995, and in Korea the average income increased sevenfold. So that's not nothing, you know. There's a major phenomena going on there. So just some anecdotes really. The story of Southeast Asia had been one of the most amazing success stories until the late 1990s, of course, and that's when the problem started, and people started to debate then whether the economy had been based on, whether the success in the economy there had been based on fiction. You know, was there something going on there that people hadn't known about beforehand? Was it all now sort of turning out to just be a mirage? Maybe there had been corruption, maybe there had been internal sort of favoritism showed to certain companies and things, and maybe the books had been cooked. A lot of people say that about China today, and I'm not an expert on what the figures are there truthfully, but we can talk about that in another class. Anyway, the reality is that the region had huge growth, and in fact in 1997, which was the year the financial crisis happened, the IMF had actually predicted that there would be 7.5% growth in the region. So even on the verge of the financial crisis, major international bodies like the IMF were basically saying that there was no sign of any trouble at all, that the financial crisis was not imminent or anything like that. So it had the whole area had a really great credit rating. There was no problem getting money in. And just that year, The Economist magazine had run an article. Actually, no, apologies. In 1993, just a few years earlier, The Economist had run an article saying that it was like the most momentous thing that had ever happened in recent years. I quote, they said, "It is now likelier than not that the most momentous public event in the lifetime of anyone reading this will turn out to have been the modernization of Asia." So, there was a lot of faith in this idea, and it's not clear that the faith was ill-founded from the story up to 1997. But then, of course, the debate started. One of the major issues was the fact that the value of the US dollar was going up, and of course, most of these countries had borrowed cash from America, or their debt was denominated in US dollars. So that was a major problem. If the value of the money that you are owing is going up, then you're going to be in trouble, especially if you owe a lot of it. The Japanese economy, which was a major consumer for raw materials from the region and for advanced products from the region, was starting to dry up. The Chinese were becoming more competitive. They devalued in 1994 by 50%, which was going to put major pressure on the other economies in the region. And the Chinese seemed to be, sort of cynically trying to manipulate. Some people would say anyway, a 50% devaluation was pretty major. So the Chinese were definitely trying to make their exports more competitive. But most importantly of all, I think there was a glut in the semiconductor industry. Countries like Taiwan had invested a lot of resources into building up a semiconductor industry, and they were now going to find it hard to get their materials onto the market. So here's the thing: those countries, all of them, had their currency pegged to the US dollar within a margin, sort of like in the Bretton Woods system. They were trying to maintain currency stability. And this was in order to keep investors satisfied, because investors don't like to see currencies fluctuate too much. They like to see stability. So one way you can invite investors into your country is to maintain stability. But if you owe a lot of money, and these countries did, the individuals in those countries did not, the countries themselves did not, but the companies, the large corporations that existed in those countries, like Daihatsu, Daewoo, Toshiba, all the rest, these are the large super corporations that are in Asia and Southeast Asia especially. They were owing a lot of money measured out in US debt. So if the countries in question were going to delink from their peg, they were going to suddenly start finding it difficult to maintain the stability of their currency, which would mean that the currencies would go down. And that would make it even harder for those large corporations to pay off their debts. So certainly that's the story at the sort of geopolitical level. But if you understand another important variable about what was going on in these countries, why were they having difficulty maintaining the value of their currency vis-a-vis the US dollar? Another major point to bear in mind is that these countries were all sort of seen to be hot properties, and their cities, their populations were moving into the cities, and Western investors were very curious and eager to get a little piece of the action. So when the Western investors looked at the Asian region, they saw what they thought was going on there as a big deal. They thought they saw major growth prospects going on and on into the future. So they thought at the individual level to try to invest substantially in those currencies, into those countries' economies, to be specific. And one of their chosen areas to invest in was property, right? Because that would have been a major thing going on at the time. The emergence of Hong Kong and Singapore and places like that, Bangkok, as cities in the modern sense, they were starting to develop skyscrapers and high-rise buildings. and modern contemporary looking apartment buildings as well. So the foreigners, the people living overseas, of course, are riding the tide of a buoyant U.S. economy. The value of the U.S. dollar is going up, as we mentioned. The Japanese economy was stagnant. There were all these sort of competitive pressures, but in the meantime, the property sectors in these countries looked really, really buoyant. So Western investors were doing their utmost to try to get a little piece of that action. So this is kind of a weird thing, right? So you've got to sort of pause a little minute and try to imagine what I'm telling you. There was a property bubble emerging in the cities while the economy's basic conditions were starting to change, right? The reasons why they had been successful for the past 30 years were starting to look a little bit different. And that's what we need to understand, and that's how we need to sort of move forward here with those two pressures. The pressure, one, on the economy and the indebtedness of the major corporations, and on the other hand, the fact there was all this hot money, this hot cash moving into these cities to buy up apartments and things like that. So one of the major issues here for these countries was going to be, if there's all this hot money flowing into the country, what would have been the parachute mechanism for these countries were pushed to come to shove and all that money to suddenly leave? As in, if people were to take a fright and start trying to withdraw their money. Well, normally in that sort of situation, what would happen would be the central bank would step in to try to buy up enough of the country's currency to bring its value. We have a supply and demand function for currencies. Currencies are like a global popularity contest, as is often said. And countries' currencies can go up and down depending on how much people want of it. So while everyone's, of course, flooding money into the country, people want a lot of that money. Because if I want to buy an apartment in Bangkok, I have to have Bangkok money, right? It's called the baht, B-A-H-T. And if you are going to be investing or suddenly want to take that money out of Bangkok, if you sell your apartment and suddenly move it out of there, that'll be more baht back on the market again all of a sudden. And if everyone's doing that, selling and moving out of the currency all at the same time, then you have a problem, because that means that the central bank will have to do a lot of work to buy up, use its reserve currencies. Usually central banks keep like yen, euros, dollars. Well, the euro didn't exist at that time yet, but they would have had German Deutschmarks and French francs and other things like that, pounds sterling, in their central bank to try to shore up and reinforce their currency in an emergency. It's kind of like having a seatbelt. And if the currencies were going to have a trouble, then there would be have that seatbelt there at their disposal. But the problem, of course, was that the seatbelt was starting to get a little bit compromised, because if you think about it, with all that foreign money being converted over into baht, that's a lot of baht moving into the country, and it's sort of like a time bomb, because if it suddenly starts to shift the wrong way, that could drop a whole bunch of cash in baht currency onto the global markets for baht. And if there's that kind of what happens if one day there's 2,000 more loaves of bread available in Chillicothe in the markets, in the shops in Chillicothe? Well, it stands to reason that the value of bread in Chillicothe is going to just fall through the floor. Why would you buy it from a supermarket when you can buy it from the guy on the street for nothing? So would the central bank be able to buy up enough? If there was central banks can do a lot of work, but they can only do so much, right? And so that's really the sort of problem that they were trying to anticipate. Anyway, perhaps we're making this point a little bit too complex, but the simple point I just wanted to make is that by looking at the intent, you can figure out what the intentions of the investors was by looking at the way that they had financed their decisions to move into the property markets in places like Malaysia and Hong Kong and Thailand in the first place. And by understanding that they had only got short-term access to cash, you can understand that a couple of things. One, that they thought that the property markets in Bangkok and places like that were going to go up really, really fast. And then the other was that they were willing to take on the additional cost of borrowing in the short term, because borrowing short term is expensive. They were willing to take on the additional cost of borrowing in the short term in order to pay off, in order to get into these markets, understanding that the markets were going to be so explosive that they would earn so much money back that they could even take on the higher interest rates of the loans that they owed back home. So really, we're just trying to track down a couple of things. One is the intentions of the investors by looking at what how they were positioned, and then second of all, their willingness to move out of the country at short notice. They were not wedded by any means to staying long term in places like Bangkok. And then thirdly, of course, most importantly, were these investors to get stung, their exposure to the difficulty of paying back their Western banks once they were getting or trying to get out of the Asian economies in the first place. And that would have meant that the Western banks would be exposed to the risk as well, because it would mean that maybe they would never get their money back either. So in terms of the financial crisis itself, now that we've described the context within which the financial crisis took place, we have to contend with some of the sort of immediate scenery of 1997. We had, on the one hand, Hanbo Steel Corporation declaring bankruptcy. Then we had Sompersong Land declaring bankruptcy. These were large corporations that were finding that they had over-leveraged themselves in U.S. in the dollar loans that they had borrowed. Remember, we said that the price of the U.S. dollar was going up. So these countries were finding that they had these companies rather were finding that they had not enough access to short-term capital. Now, here's the thing: these were huge companies. They were actually doing quite well. They were profitable. But they were basing a lot of their operations on borrowings, and that's fair. A lot of companies do work on fairly sizable borrowings. But if you are going to be working on borrowings and then the profile of those borrowings changes, you can be in trouble. So that's just something to think about. Now, the Thai government had promised not to do anything, to let these loans go. And that was something that the markets had sort of found reassuring, because it didn't give them too much concern about the condition of the Thai state and its finances. It just looked like a financial crisis that was limited to the corporations. But by June, it became very obvious, and then it looked like to international investors that the Thai economy was going to have to intervene to shore up the condition of its corporations by bailing them out. And that's when the trouble really starts, because international investors knew that the way they could see the dominoes lining up, they knew that eventually the Thai baht would have to devalue, that eventually there would be a flood of foreign currency, a flood of currency out of the Thai baht into foreign currencies, and that would lead to a devaluation. So they used financial markets. There's ways you can do this to try to engage in what's called speculation, whereby you make bets in the short-term market in the hope that you can pay them back in the long term based on a change in currency. So I can borrow, for example, if I think that the Irish currency is going to devalue next week, I can borrow money now in the future that is going to allow me to buy up and then crash that currency by selling it on the short-term market, and that's exactly what happened. So the speculators were able to move in there, and as a result, the Thai baht crashed spectacularly, 25% overnight. By August, there was what was known as the contagion effect, and the countries like Malaysia, Singapore, Indonesia were following exactly the same way. But interestingly, it wasn't just a crisis that was contained within the region. Later that year, Russia and the USA were hit as well, because Russian banks were exposed to the Asian banks, and then of course US investors had invested in Russian banks. So if the Russian banks were taking a hit, that would mean that the American banks would take a hit too, and then before you know it, you have a chain reaction. And the famous event in the United States to do with this was a company called Long-Term Capital Management, or LTCM, and LTCM had to be bailed out by the Clinton administration later that year. And that was a fairly spectacular indication of just how dangerous these things can become. So by the end of the year then, everything had turned upside down for the Asian economies. What had started in the region as a liquidity crisis, that is to say the corporations that were where the problem had started, were not really in trouble before 1997. They had a lot of debt, but the debt equity ratio wasn't too bad, and so really the reality is that the countries were just short on cash. It was a short-term cash issue as opposed to any indication of a fundamental corruption on anyone's part. They were very viable corporations. They were producing things, they were employing people, and there was demand for their goods and services. Certainly the region had taken a hit in terms of the crash in terms of semiconductors in places like Taiwan, but that was not generalized to the whole region. So what had started then as this short-term liquidity crisis had ended as a long-term development crisis. And what we mean by that is it had ended as a crisis where people, psychologically speaking, global investors, now are looking at the Asian economies as being kind of like slightly backwards or slightly unreliable options. And so what that was inevitably going to mean was that people were going to want to withdraw their money out of the area and just give the whole area wide berth. So that means that outside the region, global growth expectations were going to suffer, because this was such a huge area, such a large part of the world's economy. If it was going to enter into a depression, it would affect consumption of goods and services from other parts of the world. So naturally it would affect European jobs and American jobs too. And also I think what it was indicative of was the beginning of a speculative trend or a speculative tendency that we were starting to see, because of course who were these speculators that had moved in to bring down the Thai baht? Why were they engaging in the kind of speculation they were engaging in? Well, clearly they were not necessarily conspiring with each other, but they were an organized phenomena. They knew how to act together. They knew how to bring down a country's currency, and so this was going to be something that was going to characterize the stage, if you will, for world markets moving forward, because of, effectively, as we've mentioned before, neoliberalism likes to deregulate these markets and not sort of police them or secure them. So if that was going to be the case, then what might be the result? So I want to discuss with you two interpretations, and I guess really from the exam, from the perspective of those of you looking to study for the exam, the final, this is really where you want to focus your attention. The market, the stock market in Asia, it's said by this interpretation A, which is the interpretation of Cronyism, that the players in the market didn't really know what they were doing. They didn't have full access to information. They didn't realize how weak the Asian economies were. And so from this perspective, then there's a few factors that seem to explain why the financial crisis happened. One is that there was cronyism. There was no moral hazard restraint. What does that mean? Well, moral hazard is a term that comes from the insurance industry. It's a sort of a strange term, because it means that when you drive your car, if you're wearing a seatbelt, you're more likely to drive erratically. You're more likely to be a bad driver if you're wearing a seatbelt. If you're not wearing a seatbelt, you've nothing to protect you, so you're going to be much more hesitant to engage in risky behavior. So because the large corporations in these Asian economies were, how shall I say, these large corporations were so protected by the governments there, and the government was sort of protecting everything they did. It was thought, kind of like the financial crisis that's happened here in 2008, if the government's going to step in and bail out large banks if they make mistakes, then why wouldn't the banks just keep engaging in risky behavior? So that's kind of reason one. Reason number two would be the excessively risky investment, the price bubble in housing. That of course, as we would say though, is a phenomena that would have been happening while people didn't know full information about the economy. They didn't know how bad the condition of these large corporations was. The third reason would be pegged to the dollar was unsustainable. These countries were trying to maintain values relative to the US dollar, which were unrealistic in the long term, and they nurtured in the market poor expectations. So if the true value of the currencies should have been a lot lower, and this true value was revealed by the crisis itself when the currencies fell off a cliff, then basically what that means is that the global investor community had been kind of lied to and had unrealistic expectations that were not their fault. So you see who's getting blamed here, right? It's the countries were getting blamed. It was the corruption and cronyism of the countries and not the global investment community. Other factors would include data and transparency and the spiral of devaluations, because of course once we know what's going on with these countries, we have once everybody knows what's going on with these countries, they start to try to devalue their currency to make their goods more competitive. They're already devaluing because of the weakness of their currencies, but then they start to devalue even further and to try to get an edge on the markets. And that's not that's a kind of a beggar thy neighbor approach, and certainly I think it did happen to a certain extent in the Asian financial crisis. So that's interpretation A, and I'll read you a quote actually which is relevant to this, relative to interpretation A, where they say, a combination of inadequate financial sector supervision, poor assessment and management of financial risk, and the maintenance of relatively fixed exchange rates led banks and corporations to borrow large amounts of international capital, much of it in short term, denominated in foreign currency and unhedged. As time went on, this inflow of foreign capital tended to be used to finance poor quality investments, i.e. what we've been talking about, housing bubbles and that kind of thing. So you see here how the crucial variables were the flow into the country of short-term capital denominated in foreign currency, which means you'd owe it back, which means you were vulnerable to changes in the price of that foreign currency. And so as time goes by, this inflow of foreign capital being used to finance poor quality investments as the opportunity for good investments dries up, which happens eventually in most countries. You know, whenever you see a property bubble, it's usually because there's not much else going on in those countries that people can invest in, so they decide to invest in property, and it's never really all that stable or a good idea. So in the next slide here, we see Alan Greenspan. He would have been one of the key figures associated with the negative interpretation A, that is. And here he says something very short and succinct, which I think if the previous slide maybe confused you a little bit, in this slide we summarize it in just a nutshell. Alan Greenspan said around about 1997, 1998, it is evident that East Asian economies could not provide adequate profitable opportunities at reasonable risk in the 1990s to absorb the surge in capital inflows. What's he saying here? He's saying that the countries were basically oversold, right? They were the marketing, the branding was too powerful, and the countries were not able to sort of make good on on their promise, right? They weren't really as amazing miracle economies as they were being made out to be, and so the countries were subject to flows of capital into their economies that were sort of looking for profitable things to invest in, but all they were finding was the housing bubble, and that's what housing bubbles never last. So one of the things we need to contend with here on this slide is interpretation B's sort of very, very different positioning of some of the narrative of the financial crisis. The first points we need to sort of make are that, really both politicians in the area, but also some of the world's most formidable leading economic experts were able to sort of step in and analyze the situation and come to some kind of contrary analysis to the analysis that was being put forward in interpretation A, people like Alan Greenspan. first of all, we have Mohamed Mahathir, who was the Malaysian Prime Minister. What he basically suggested was that the speculators were deliberately capsizing the economy, taking advantage of a momentary weakness, which was not really a fundamental weakness, but a momentary weakness, a lack of access to ready cash. And as a result of that, they were capsizing the economic system of those countries. And I think actually when you look at the facts of the matter, there's a certain amount of truth to that. I don't know if they were bent on unholy actions. He might have been sort of exaggerating some of the motivations there to a certain extent. But certainly his views would be supported by very moderate mainstream economists like Jeffrey Sachs, who with his co-partner at the time, his writing partner Radelet, they said that there had in fact been an overly exaggerated euphoric inflow of capital into the area, and that it was really sort of the investors' fault that they had sort of deliberately ignored some of the facts of the matter. That it wasn't so much that there was cronyism, but that there was an Asian way of doing things, and that this Asian way was not the same as the Western way, but that this change in the global marketplace, the shift in the price of the dollar, had exposed a momentary weakness in the Asian way of doing things, but that overall the 30 years of tremendous success that those countries had enjoyed was a real success, and it shouldn't be disregarded so casually. Then Robert Wade stepped in with an even more sort of powerful argument in this regards, because he started to look at also some of the reasons why the Asian economies had such open markets in the first place, because after all, if they were traditionally very state-led governments, then what were they doing having all this open access to global cash in the first place? Well, why wouldn't they have had very simple mechanisms, for example, like taxes on short-term capital movements or restrictions on short-term capital movements? They would have done great work actually to slow down the speed at which the money was being taken out of those countries in the first place. And actually those kinds of regulations are very common in developing countries in the first place. So it's kind of confusing why they would have not done that. He said Wade explores this and finds out that there's actually a very good reason why this happened, because as we'll see, the IMF, the World Bank, and the World Trade Organization had forced many of these countries to engage in Western-style market liberalization, what we've been calling in other classes neoliberalism, the ideology of letting the free markets determine everything in the regulation of the economy, was sort of the password here. So these countries, despite the fact that they didn't have the kind of rigor of the Western-style institutions with the central banks and everything like that the Western-style governments have, they were being asked to contemplate these very sort of radical neoliberal-style market liberalizations. And of course, fast forward to our own time, if you look at many of the countries in Europe, these were Western-style industrial economies. We know even now that Western developed countries are not immune to some of these pressures and difficulties when it comes to international financial markets. So certainly this argument about the Asian economies holds some water if you think about it in that light. The question here, the crucial question here, is which interpretation won? The IMF was guided in its response to the crisis by interpretation A. I think it's very, very obvious. The IMF is an organization that is supposed to be there to protect the countries who are the members by providing them with liquidity, with cash, in other words, which they may need from time to time. Any country will need this from time to time in order to take care of its short-term cash needs and allow them to pay it back at a reasonable rate over time. But since the introduction of neoliberalism, I think it's very clear and safe to say that the IMF has become a more dogmatic organization, an organization that has pushed a sort of an austerity agenda, a neoliberal agenda that has tried to encourage nation states to get out of the business of providing support for their economies, to let the market make the decisions where possible, And so when the IMF, found itself confronted by this particular crisis, the idea of providing cash to allow the countries to bail out their crisis-ridden corporations was overlooked, and instead the IMF refused to allow countries to engage in that bailout. It used the crisis then as an opportunity to ram through very punitive reforms. For example, it forced the Indonesian government to get rid of its subsidy for fuel, which I think was very difficult for a lot of people in Indonesia who are farmers, especially who are trying to sort of run farming machinery. Often they're very poor and they're finding it difficult to run that machinery without gasoline, which traditionally had been subsidized in Indonesia. Another reform, I think, which was very difficult, was to introduce flexible exchange rates where none had existed before, thereby making it difficult, for example, for many people in this part of the world to send their sons and daughters overseas for education, where they had sent them overseas before, perhaps, to get university educations, especially the middle class in those countries. Now those educations were going to be far too expensive for them to afford. And also they hiked interest rates, making it very difficult for people to borrow money in order to try to ease pressure on the balance of payments. And altogether these things really, as Mark Blythe would have been arguing in his video that we've been watching for this module, it's just, again, it's this idea that you can't tax the government, or you can't cut back on government spending when there's been a crisis, because really for most types of crises, which are crises of demand, the worst thing you can do is cut back on the government spending, because when the private sector withdraws, really the government is the only sector there really to be able to do anything. So certainly the Asian crisis was guided by an ideological interpretation, it seems. Then there is a clear linkage between the interpretation of the crisis that the IMF adopted and its policy preferences in terms of its tendency to prefer neoliberal solutions to financial problems. But interpretation B was a very plausible interpretation, and even though it was not the interpretation ultimately used, many people argue that it would have been the better interpretation to avoid the damage that happened in the long term. I mean, let's remember we were talking about Mahathir, the Prime Minister of Malaysia. He ultimately delinked the Malaysian economy from the world economy for a little bit of time because he didn't want to accept the IMF medicine, and he would prefer not to be part of the world market and be punished by it. And actually Malaysia recovered from the financial crisis very, very quickly, perhaps more quickly and in a more independent fashion, and a stronger fashion at the end of the day than the other countries. So that's very interesting. Mahathir, of course, is a controversial figure for other reasons, but certainly the financial crisis seems to have been a moment where he showed uncharacteristic leadership and analysis compared to some of the other countries in the area. So I think an important question that we should ask now is what does this case tell us about global power? The IMF is a centripetal organization. What we mean by that is that its power, it doesn't have a power separate to the nation states that compose it. In fact, the IMF is composed of the desires of the nation states that contribute to it. So we have to keep that in mind when we're talking about the IMF. Each member country of the IMF contributes a certain amount of money called a quota, and that means that some countries get more votes than others. The quotas are good, though. They do give the IMF financial resources that it can use in order to serve its function, which is as the lender of last resort for troubled countries, as we were just saying on the last slide. However, it does distort the balance of power in the IMF, and it means that countries like the United States and the Western countries have a greater role in the IMF than the poorer countries, are the southern countries. So in that sense then, although the IMF still plays its basic role as the lender of last resort for cash-strapped countries, it's increasingly doing it at the behest or in a manner that seems to recognize the preferences of the Western powers, who are increasingly neoliberal in the way they look at the world. So in the case of the financial crisis, then, it would seem that that's actually been the case, because as we know, the financial crisis reduced the cost to Western investors of a lot of Asian factories. They were able to buy them up at very cheap prices, and it pretty much disabled the financial autonomy of Asia. As we say, there was one sort of contrasting example, and that was Malaysia, but the rest of the Asian countries were pretty much sucked into the global power regime. So what do we say about the conclusion then? We talked earlier on, I believe, about the Washington Consensus. The Washington Consensus is a way of referring to the constellation of powers, including the Washington United States Treasury, Washington-based United States Treasury, and the Washington-based IMF and the Washington-based World Bank. You see all these financial organizations are based here, aren't they? So that's very sort of convenient for the Western powers, and America in particular. So the interpretation chosen by these organizations may have been just a bit too harsh. What they actually saw as cronyism and corruption was actually a uniquely Asian way of doing things, perhaps. And this is the point, of course, that Jeffrey Sachs and Robert Wade were making. And the question is, how was Asia supposed to develop if it wasn't going to use such an Asian way of developing things? After all, the industrial markets had all been sewn up by the Western industrial powers. If the Asian countries were going to modernize, wouldn't they have needed a strong state-led way of modernizing themselves? The financial markets weren't going to invest in Asia otherwise, so it wasn't going to happen through the marketplace, which is what the Western powers sort of were suggesting would happen. So by the governments in those countries taking a strong protective role and nurturing those countries' economies and nurturing their industrial sectors in particular, those countries were able to develop over the 30 years after World War II up to then the 90s. Really just in such a strong way. So it's important to give them their due. As Joseph Stiglitz argues, at the end of the day, the actual crisis itself was a bit surprising. All these people who had previously been praising the Asian economies were now all of a sudden criticizing them and saying that they were guilty of crony capitalism. They had all been talking about the miracle of the previous 30 years and praising Asia. And so he offers a quote, which I will recite to you here. He's like, "How I wondered if these countries' institutions were so rotten, had they done so well for so long." So he was obviously mystified by this idea that, that if these countries were totally corrupt, that they would have been able to get ahead as they did at all. So from Stiglitz's point of view, from Robert Wade's point of view, and from Jeffrey Sachs' point of view, the actual crisis was caused by inappropriate and ill-conceived reforms forced by the IMF and the World Bank onto these countries as a sort of cost, or the price of admission, if you will, into the world economy. The World Free Trade Organization, the WTO, was also involved in this as well. So that's really the end of the story here about the Asian financial crisis. We've looked at its causes, we've looked at different interpretations of the causes, and we've looked at some of the consequences, and we've developed an argument that, in fact, the way the crisis was interpreted and the way the crisis was ultimately resolved was very much indicative of a certain bias on the part of the Western powers, but not just a bias that had strength and force to back it up, because the Western powers have, of course, the hands on the purse strings of the IMF and the World Bank. So thanks, folks. That's this week's wrapping up of the economics section of this class. And next week we'll move on to other concerns. Take care. Bye-bye.